All right, cool. So today we'll be finishing up the DCF. So could everyone open that Excel sheet I sent out earlier today? Unless I only sent it to one person. So hopefully not. All right. Or let me know when you have that pulled up. All right. So basically, the only change I made actually, so if you've clicked this plus sign here, whatever this is, expand other assumptions, I actually changed this to 18% because I took a peek at their 10Q and they're like, yeah, our adjusted tax rate's 18% for this quarter, so I just used that, which is why the numbers slightly changed, but that's the only change I made. So to basically review real quick, so last week we projected these things out and we got this unlevered free cash flow during our 5-year projection period. And today we'll be doing stuff with that to arrive at an implied share count. I also took the liberty of calculating EBITDA. So this is just your earnings before interest and taxes, adding back your D&A to get earnings before interest, taxes, depreciation, amortization. And this will be used when we're doing the enterprise, the exit multiple method for calculating enterprise value. Great. Okay, so hopefully that was a good refresher. If you have any questions about what I did, feel free to ask. Cool. So basically today we'll be doing steps 2, 3, and 4 of the DCF. So going back earlier to our PowerPoint from last week, we've done step 1, which is project free cash flow. Then we're going to kind of go out of order. We're going to do calculated weighted average cost of capital first, determine our terminal value, and then discount it back to the present value. So first, let's talk about calculated weighted average cost of capital. So you can see here, this is the formula again. This is the equity percentage of the capital structure times the cost of equity plus the debt percent of the capital structure times the cost of debt. Times 1 minus tax rates. So from here, let's go to so basically today we'll be going over what each of those things mean on our Excel sheet. So hopefully that will put it more into context. So if you go to the Excel sheet on the WAC tab, you can see that we have several different items. So I did most of the stuff for you kind of. So the first thing to do is actually to calculate what beta is. So our first metric of beta is 0.53, and this is directly taking off of CapIQ, who calculates it themselves using previous market data. And basically what this is saying is for every % increase in the market proxy, in this case the S&P 500, we expect that there will be a 0.53% increase in the share price. So there's a positive beta, but since Kellogg's is a pretty stable consumers company, they will be less volatile than the market, which is why their beta is less than 1. So that is the first way to calculate beta. Just look at the stock price's historical performance relative to the S&P 500, which is what all these database and financial aggregation sites use. So then the second way is to essentially do a comparable with your comparable companies. So, and how that works is you take General Mills, Mondelez, and J.M. Schmucker, which is the 3 companies we're using as our comps in this exercise, and we're going to look at their beta, which is the levered beta, and then we're going to unlever that with their capital structure, which you can see the equity/debt, and then we're going to relever it based on the capital structure of Kellogg's. So I guess this wasn't part of the PowerPoint, but essentially that General Mills has 26 so $26 billion in equity and $13 billion of debt. So therefore, their debt to equity ratio is 0.5, and then their tax rate is 20.9%, their effective tax rate. So then you have this unlevered beta. So this is saying that in the past, like whatever years or so, for every percent increase in S&P 500, General Mills has increased by 0.69% whenever the S&P 500 increased by 1%.
Where do you get, like, where can we find all of these numbers?
Okay, that's true. So General Mills, this is the, right. So if you go on, I just use Cap IQ for these.
Okay, so it's just us.
Yeah, so this is the current, so this is the basically the Q3 data, so the most recent 10Q data from like their, so this is, right, so this is their debt from the most recent 10Q, and then this is their market capitalization. So we actually calculated this last time, or in week 4, which we're doing comps, because we calculated the equity value of General Mills. So I got it from here, where you take the fully diluted shares outstanding multiplied by the stock price. The other thing you can do is just, I mean, so the thing, so right. So I hear you. So the other, so you don't actually have to do this, especially since the pitch is next Tuesday. So honestly, I would go to, so you can see that the market cap here for General Mills is actually much higher than the market cap we have, which probably means General Mills has increased in price since 2 weeks ago. But you could just take this number right here on their market cap. Yes. So we're trying to do stuff legitly in Ed Series, but when you're in a time crunch, Cap IQ is your best friend. Right. And then for your debt on the balance sheet, oh, that's just a tear sheet. Right. So then with your debt, you could just take the debt figures off of this. So this is them just literally taking these numbers from the most recent 10Q. So you could just use this on Cap IQ. Ideally, you'll actually dig up their 10Q on SEC Edgar, but like, I would trust Cap IQ that they could scrub numbers directly off of SEC documents. So I would say these numbers are pretty accurate.
Where do you get all the last numbers, like risk-free rate and like RM?
Right, yeah, so we'll get to that.
You
Yeah.
can just like find those?
No, I did find those. So, yeah, I'll show you where I got them. Right, yes.
When you say so if the General Mills, if the levered beta at the S&P 500 goes up 1%, their levered beta is 69%.
Or 0.69, yeah.
So is there like a range that you want, like is there like an ideal range? Like,
Oh, so where I got this 0.69 is, so again, your tear sheet's your best friend. This is just, a tear sheet just means you're summarizing this company stats. So you can see that their beta is 0.69. So, and in the 5Y just means, I believe means 5 year. So this is just looking at historical data over the last 5 years.
so does it have any like significant meaning like in comparison? Because we have like it's just like 0.69%. Like is that just like a factor?
Well, so again, so the 0.69 is determined. So if you take the last 5 years of data, of market returns data, of the General Mills versus S&P 500, it's basically the covariance of the returns of the General Mills divided by the variance. So it's the covariance between S&P 500 and General Mills divided by the variance of the S&P 500. So that's how they, or like whatever market proxy Cap IQ uses. So that's how they arrive at this number. Right. Hello, Nick. Cool. So why don't I open up the Excel sheet? I was just going over where I got these numbers. So these numbers are basically mostly Cap IQ stuff on the tear sheet / the balance sheet. So I'm just going over those. Right. Yep. Right. So and then, right. So does it make sense where I got all these numbers? Great. And then you have the unlevered beta. So this is a complex equation that you could just take this template, plug in the numbers for your pitch. Basically, So I will send out this link, but Investopedia is a great resource. So this link will explain why this is. So this is the equation. And essentially, levered just means this is both equity and debt. So this is volatility of the whole enterprise, and an enterprise has both equity and debt to it. But unlevered beta is just a market volatility of equity. So essentially, what is going on is you are taking the leverage out of this number, so that's 0.5, and then you're reapplying the capital structure of Kellogg's over here. So you don't have to understand what this means as of right now, but that's just the interview answer that you'll give, yes. Right.
To sort of find like the true risk of the business and not necessarily like the risk of the
right. Or, I mean, the debt obviously adds risk to it,
right.
But because the debt and equity of each company is different, that's why you need to account for that by taking out the debt piece of your comps to get your unlevered beta, and then you want to re-lever it once you try to calculate it based off of Kellogg's. So you're basically taking their unlevered beta, which is a useful information you want, and then you're reapplying that to Kellogg's and their specific capital structure.
You apply all of the other companies to Kellogg's capital structure?
Right. So they're unlevered beta. Because we don't want their levered beta because the capital structure of their other companies is different than Kellogg's. So we're taking the useful piece and then modifying that with the specific capital structure of Kellogg's. Cool. Right. So then you get this number through this equation. And then you have basically your mean and median. And then this is just equal to, So they're the same number. So in this case, it doesn't matter, but it looks like I flipped the mean and median again. Or they're both the same number. Okay. Well, anyway, since they're both the same number, so I'm going to modify that real quick. Right. So they're basically like 0.67 and 0.66. So very, very close. As you can see, because this is just rounding off in 2 decimal places, which is why you see this, but essentially it's just 0.66 and 0.67 for their re-levered beta according to CapIA, according to its comps. All right, did that make sense to people? All right, great. So now once we have calculated beta from this, you can go to the weighted average cost of capital. So first, we want to calculate the cost of equity. And then going on our PowerPoint from last time, we have our capital asset pricing model, which is the risk-free rate plus the beta, which we just calculated, times the market risk premium, which is the expected return of the market, minus the risk-free rate. So basically, the risk-free rate is 1.91%. And as mentioned last time, we used the 10-year Treasury, the U.S. 10-year Treasury as a proxy for risk-free rate. And the reason this is risk-free is we assume that the government itself is risk-free because the U.S. can always print money to fulfill its debt obligations. So therefore, the risk-free rate is 1.91%. And the reason the risk-free rate is 1.91%, so if you Google 10-year Treasury yield, you can see that, okay, that's not it. So if you go to CNBC or some other site, so this will tell you that the 10-year Treasury yield is around 1.921. Currently, it's something different. But as of the time when I did this, it's 1.91. And this is just, what this means is that the yield to maturity is 1.91%. So basically, I believe it will return 1.91% annually. Yes, 1.91% annually if you buy a government bond, so, which is why it's risk-free, and that's our proxy for the risk-free rate. And then a risk of the market is just what people expect the returns from your market proxy will be. So this is just saying if we basically invest in every single stock possible in the world, or like we use S&P 500, which is the 500 largest companies by, I think, market cap. So from there, we will use whatever our market proxy is. We'll just use that. So I also got this online, but I think this number should actually be lower as of right now because people are expecting a recession to come soon. So people are expecting lower market returns. But this was done like quite a while ago. I got this number quite a while ago. So I just plug in 9.8% here. But I think if you look at market risk premium, or like if you just look at market risk premium, like different companies will put out different reports. Normally we use something called Ibbitson's, but I don't think we have access to it. At least I couldn't find an access to it, so I would just use this website. As you can see, like the market risk premium used to be quite high, or the market return used to be quite high, and then it has since crashed, going on as the like growth period has started, has continued on, and now that people are expecting a recession, it's starting to dip lower. So basically, this is where you get it, and then, which is where we got 9.8% from. At least this was done a while ago. So then the market risk premium is just the rate of return of the market minus the risk-free rates. So then you have this minus that. So you get a market risk premium of 7.89%. All right, cool. And then you have your beta, which we calculated before. So I just literally took the average of the mean of the comps and then the beta we got from CapIQ. Cool. So then that's 0.6. And then this equals, right, so this equation is, as you can see here, we use the risk-free rate plus beta times market risk premium. Yeah. Right, so it's risk-free rate plus beta times market risk premium. So this is equal to risk-free rate. Sorry, what was the question?
Yeah, so 0.6, it's already inputted for us, but what's the equation?
Oh, it's the average of the thing on the left.
Okay.
Yep.
Wait, but how come when I do the average of that, it gets like I just, because it's already inputted, so I can't really do it on that column. But when I do it in the column below, it gets me 51.3. Something weird is going on.
Yep.
So like it's already here, so I'm not gonna do it on the column. But like if I try to do the cost of equity, it's just like to get me the same number. Like you're still just doing the operation, do this and this, and it's that.
Oh, that's a percent. So
Yeah. So why is that happening?
because
When you move it over, you get 6, you get,
right, it's like so for example, like,
If you're saying it rounds it.
right, well, because like, let's say I copy the value of that somewhere else, it's actually like 0.59 something.
Oh, okay.
So like, if I convert it to a percent,
Yeah,
then it's 60,
right.
yeah. Yep, cool. So then you have your cost of equity, which is your risk-free rate. So it's L5 plus your beta and times your market risk premium. So that gets you to 6.6%. Cool. And then, so from there, this is your cost of equity. And so now we're going to calculate the cost of debt. So this 2.37% is the yield on a Kellogg's bond. So this 2.37% means the same thing as this 1.91%. So if we invest in a Kellogg's bond, how much can we, what's our yield of the bond? So this 1.91 and 2.37 means different things. As you can see, the Kellogg's bond and the, so the Kellogg's bond is greater than a risk-free rate, and that makes sense because the government is risk-free and a company's not. But you can also look this up on some database like Bloomberg, or you could just Google like what is the yield to maturity of a Kellogg's bond, and therefore then you'll get 2.37. And normally this should be way higher for other companies, but because Kellogg's is a very stable consumers company, that's why it's lower, because people aren't going to expect them to default on their debt anytime soon. So people feel comfortable with taking a lower yield to invest in a bond. And therefore, the after-tax cost of debt is this times 1 minus the tax rate. Because again, because the cost of debt is them paying interest on the things that they like, the money that they borrow from other people. So interest expense gets deducted from your tax, which is why the true cost of debt needs to be tax adjusted. So since the tax rate is 18%, then only 82% of what they pay in interest is actually like a cost of the company, and they save 82% of that through taxes. So therefore, the cost of debt is only 82% of the 2.37%. And that gets you to 1.9%. So 1.9% is 82% of 2.37. All right, cool. So then now we want to weight the cost of equity and the cost of debt. So basically you can see that this equation for debt to total capitalization is 8770, which is Kellogg's debt, divided by equity plus debt. And then you can see that 06, which is equity total cap, is basically the equity divided by the equity plus debt. So it's a percentage of how they fund their assets from both equity and debt, and a percent of that that's debt, and a percent of that that's equity. So basically 70.6% of Kellogg's operations are funded through their equity, and 29.4% is through their debt. So then here we just weight the cost of equity and cost of debt. So this cost of equity is 70.6%. So therefore the 6.6% is around 70% of your WACC. And then your cost of debt, 30% of your capital structure is debt. So your cost of debt you weight that the 1.9% by 30%, or around 30%. And then you get your after-tax cost of debt of 5.25%. Cool. So that's your weighted average cost of capital, and this. Right. So then your WACC is 5.25%, and this is probably lower than a lot of what your pitches are going to look like. Again, because Kellogg's is safe stock versus we're all pitching something tech related, or like something that is going to grow with tech. But since we're literally just selling cereal here, we're not going to have it that high of a weighted average cost of capital. All right, cool. Now on to the DCF. So first, this box, we're just going to copy over the WACC of this. So literally, so you hit equal sign. Oh shit, I clicked F1. So basically, all right, I'll do it again. So this is just equal, and then you basically just want to click your WACC page, click this, and hit enter. Are you all there?
How are we getting all these things that are the multiples here?
Yeah, I'll explain that.
You like found those though?
Well, yeah. So the multiple of some are comps. All right, yeah. So we'll be getting to the bottom part. We'll get to the bottom part. So then you have your discount period. So basically, 2019 is year 1, 2020 is year 2, 2021 is year 3, 2022 is year 4, etc. Which is why we use 0.5, because this 1406 of year 1 free cash flows will come throughout the year. So we're going to discount them by the average of the year 1, so it's 0.5. So year 2 free cash flows will be 1.5. So that's what we call the mid-year convention. Because if this is just 1, 2, 3, 4, 5, we're assuming all the cash flows come at the end of the year, which doesn't make a whole lot of sense. Therefore, we have these mid-years for our discounting. And then, so for our discount factor, this is 1 divided by this to the power of this. So if you go to what we have earlier, right, so this equation down here, we're basically calculating 1 over the 1 plus r to the power of like 1, 2, etc. So we already have our cash flow piece, so we're just trying to find the denominator. Okay. Right. Does that make sense, or are people confused? All right, cool. Great. So then we have our present value of free cash flow. So this is your free cash flow times your discount factor. So 1406 times 0.97. And this is, again, let's say like we're doing cash flow divided by discount rate. So that's just equal to cash flow times 1 over 1 plus r to the power of whatever, which is why we multiply them together. Because 1406 is our cash flow, and then 0.97 is our 1 over 1 plus 5.25 to the power of 0.5. Then when you multiply them together, you get cash flow divided by 1 plus 1.0525 to the power of 0.5. That makes sense to people? I guess I'm explaining. Actually, the whiteboard probably makes more sense. So basically, we have our 1406, right? So our cash flow every year, at P plus VWAC. Entire T. So our 1406 is the cash flow at time T. And then we're multiplying this by 1 over 1 plus WAC at time T. So this is your 0.97. This whole thing is your 0.97. So therefore, when you do 1406 times 0.97, we're going to get the present value of the free cash flow for that. Does this make sense to people? All right, cool. So we essentially replicate that for each of these years. As you can see, the discount factor gets less and less, which means that each dollar here is worth way less than some earlier year because of discounting of your cash flows. And then, so basically you can see here that 1537, so 1,537,000,000 in 2023 is to us is worth $1.2 billion at the end of 2018, which is what the interpretation of what this means. So then this number is just summing those 5 things together to get the sum of the free cash flow during our projection years. And then you have your basically the value of the company over the next 5 years. Let's say we're using a free discounted cash flow analysis. So then we have to calculate the terminal value.
What does the PV stand for?
PV is present value. All right. So we're going to calculate our terminal value in 2 ways. So the first way is the exit multiple method. So this 2286 is your terminal year EBITDA of 2023. And EBITDA is just your EBIT plus add back your D&A, which we did last week. And this exit multiple is an EV over EBITDA multiple. And again, the EV over EBITDA multiple is just saying how much we're willing to pay for this level of EBITDA. So here the interpretation of this is we're willing to pay $11.3 for every dollar of EBITDA that Kellogg's generates. So where I got this 11.3 is if you go back to our comps analysis from 2 weeks ago, we got a median of 11.3 for our EV over EBITDA multiple when we did comps 2 weeks ago. So we're assuming that we're going to acquire this company for 11.3 times EBITDA, and therefore we're taking your EBITDA times your EV over EBITDA, and then you get a terminal value of around 25.8 billion. All right, yes. All right, did that make sense to folks? The other number you can use for this is like your industry average. So you could just look up like whatever industry your company's in, find the average EV over EBITDA multiple, and there's usually some research analysts that will like do research on that, and you can also plug that number in. So like kind of like look at different metrics and like plug in what makes sense. I'm just putting this here because it's the median of our comps, and then we have to discount it back to present because we're using our terminal EBITDA. So this is year 5 EBITDA. So this $25.8 billion is in terms of year 5 dollars. So therefore, this is just this times 0.79 because in year 5, each dollar in year 5 is only worth 79 cents as of like present value. So therefore, multiplying that gets us a present value of a terminal value of around $20 billion. Right. So basically now we have $6.4 billion. That's our present value of free cash flow over the next 5 years. And then we have our $20.5 billion, and that's the value of our firm or free cash flows from year 6 to year infinity. So when we add them together, we have the present value, the enterprise value, which is we're saying that the present value of all free cash flow generated by a firm from now until infinity is worth around $27 billion. All right, so then since this is an enterprise value, we have to adjust it back to equity value. So then we take our debt, we add back our cash, and then we subtract our non-controlling interest to get our equity value, and this is just your standard enterprise.
Is that from what we calculated before?
Correct. Yeah, that's from our enterprise value. Yep. Yeah. So it's where and this is just from the balance sheet on your filings, which you can pull from CapIQ. We did this when we calculated equity / enterprise value on your comps analysis, and there we pulled it from CapIQ, who pulls it from your company filings. So that therefore you basically, this is just the adjustment from enterprise value back down to equity value. So you get an equity value of around $16.8 billion. And then you have around 342 million shares outstanding. So then you go from your equity value, which is your total worth of equity, divided by the number of shares of equity, and then you get an implied share price of around $50. Does that make sense? All right, great. So now we have our other method, which is the perpetuity growth method. So this is an equation you're just going to have to memorize. Again, it is this equation. So it's your free cash flow at year 5 times 1 plus G, which is 1 plus your growth rate, divided by your weighted average cost of capital minus your growth rate. And again, this is just assuming the equation where if you grow cash flows by your growth rate forever, and then you discount every year back to present, that is what that value is worth in terms of your $5. So this basically, this is your terminal year free cash flow. So this 1,537 million is this number right here. This is your free cash flow in 2023, which is where this number came from. And then your perpetuity growth rate is 1.25%. So this is typically lower on the lower range of your perpetuity growth rate. People typically do anywhere from 1 to 3%, just because the US GDP tends to grow at 3% every year. So you need to have your number below the US GDP growth rate, or else because you're growing it out to infinity, you're assuming that your company will eventually be bigger than the United States market, which doesn't make sense. So it needs to be below 3%.
The terminal year FC, I know it's from the DCF that we did before, but what line of it is it?
Oh, it's so this line. Yeah. Yes. So you have your 1.25% terminal year growth rate. So then your terminal value is just this times your growth rate. So this is getting your year 6 free cash flows theoretically, divided by your weighted average cost of capital, which is, you need to scroll all the way up for this. So this is your cell D27. So your weighted average cost of capital minus, so now this is your perpetuity growth rate, so D56. Yep. Right, so, let's see, did I mess up somewhere? This looks high. 38962. I think I screwed up somewhere. Let's see. I believe I messed up somewhere. Let's see what I did wrong. Oh, okay, yeah, I got it. Okay, so my bad. This is, sorry.
Something really weird happened on my computer.
Yep.
So I did just type that enter. What the heck?
Oh, that's just one decimals.
How do I fix that?
Wait, okay, so let me fix the error real quick. So I messed up here because this needs to be. All right, so disregard the 481. I messed up my equation. So I forgot the 1 plus. So it's 1 plus 1.25%, which is 1.0125. So you need to write a 1 plus before the D56.
Why is that a percent? What's my terminal value of percent?
Because I think I multiplied by the percent. We will fix it later. So first fix your equation. So it's D55 times. Right, so the number before was 480, but I realized I forgot the 1 plus in the equation. So it really should be 38936. Let me know when you fix that and you're here.
Yeah, I typed it in literally just like instantly. Because that's not even remotely close.
Right, so that's
Not to be able to test it. How come mine naturally wasn't in that format?
Let's see.
Why is mine naturally not in that format? Like, why was mine naturally
Because-
percentage?
I don't know. It's how it's so.
Okay.
All right. So now we're there. And so now, again, the present value of terminal value, that's the same calculation as this. We are discounting the 439 billion by the year 5 discount rate because this, again, is in year 5 numbers. So we have to discount that back to present into year 0 numbers. So therefore, we get a present value of terminal value of 30.9 billion. And then we add 30.9, and then we add our, this is all the way up. So then we add our sum of present value free cash flows during projection years. So we have D59 plus D32. Which is 37 billion. And then we just do the same enterprise equity value calculation from before because this is unlevered. This is enterprise value. So then we get down to equity value. So again, this is the sum of this with this. Right, so you have your equity value, and then divide by a fully diluted shares outstanding, and then you get $79. So this is way higher than the exit multiple, and this is pretty typical. Typically, since your exit multiple is grounded in market realities versus your perpetuity growth method assumes like a growth rate onto infinity, your perpetuity growth rate will typically yield a higher valuation to your exit multiple, but not always. And again, there's a huge difference here. Probably because our assumptions are absolute garbage, because we just did everything as percent of revenue and we didn't spend that much time thinking about it, which is why we have such a large difference here. But the actual price right now is around $64. So we are around 15 above for our perfect growth and we're around 15 below for our exit multiple. So I guess we're kind of accurate, except not really, because we have such large differences, and that's okay.
Sorry,
Yeah.
sorry to interrupt. Did you say something?
Oh, no, yeah. What's your question?
What's your formula for the equity value?
Oh, you're just summing those things.
Okay,
Because, yeah, I mean, here, because you're,
it's all of them.
right. Because your enterprise is equity plus debt minus cash plus preferred stock plus non-controlling interest. So you're basically reversing that. So your equity value is enterprise minus debt plus cash minus preferred stock minus non-controlling interest. And since I listed debt, preferred stock, and non-controlling interest as negative, you can just sum everything up
Right.
to get your equity value. All right, yeah, so we have some wild differences, but oh well. And then the last thing we're going to do is called a sensitivity table. You don't have to follow along on your computer, you can just watch me do it. But basically, this is like a cool, so basically for the sensitivity table, we're going to make this equal to this. So this is attaching this result onto the top left corner of this table. And then we're just going to highlight this table. And then we're going to go insert. Hold on. So I know the shortcut is alt DT, but let's see, where did it go? So insert, yikes. Where's in data? Oh, it's in data. So right, so insert, so we go to data, what if analysis, and then we click data table. Right, so you don't have to follow on for this. I'm just showing you all how this works. But yeah, so you do data, what-if analysis. So then you have your row input cell. So this row is saying what these numbers are, so 4.25 to 6.25%. So our row input cell is our WAC. So basically just want to click equal to 5.25%. And then we have our column input cell. So our column input cell, if you move this is from 10.3 to 12.3. So that's our answer multiple. So if you click this, that's D37. So hitting OK gets you all of these numbers. So as you can see, control 1. Right, so as you can see, it's 49.13%, $49.13 happens to be basically our implied share price. And then this you can see is lower and this is higher. So what this is doing, it's replacing these numbers at the top and then these numbers on the left for this number and this number in our calculation. And then it's going to basically spit out all the results there. So this is kind of like a sensitivity table. And this is saying, like, given these changes to our assumptions, will be the share price be if we had those numbers instead. So when we're doing this, honestly, just get to that point and then just ask your SEC directors and ask them how to do a sensitivity table and say, like, Bobby told us to ask you. Because it's called a sensitivity table. So again, we're going to redo it for the perpetuity growth rate. So again, so first you want to, in the top left corner, put your result in for your implied share price. And then you want to highlight the whole table. So on this top bar, you click data, what-if analysis, and data table. And then your row input cell, again, is your top row. So that's 4.25 to 6.25%. And that's your WAC. And then your column input cell for this one is your perpetuity growth rate, which is 1.25%. And then you click OK. And then you kind of make the numbers look better. And therefore, you get your did I do something wrong? Oh, okay, hold on. Delete these numbers real quick. So these numbers on the right, you have to hard code. All right, so we do it again. All right. Right, so all is good in the world, you have these. So you can see this is what you actually got with 5.25 and 1.25. And then you have your, or very close, and then you have your numbers that are assuming what if your WAC or growth rate was a bit wrong. And then you get those numbers. So that's called a data table. This is like typically what you do at the end. And then just make your sector directors do it because this is more Excel. Yes?
Would you like edit other numbers will automatically change?
I don't know. Let's see. Move to 6 here. Yep, looks like it. Yep. Yeah. All right, that's all for today. Again, DCF is not something you'll learn, understand as a freshman fall semester. But hopefully with enough practice and participation in classes, you will understand it once you get to your junior year. I guarantee you, most of the club that's not a junior can't do one of these. And a lot of the clubs that are juniors probably also can't do one of these. But don't tell anyone I said that, even though this is going on YouTube.